Chair Lanza. I'm here. Andrew, you here?
Here.
Sunita.
I'm here.
Howard.
Present.
Eshvar.
Here.
Dick.
Yes.
Franco.
Here.
Thank you. Dave, are you here?
Here.
Right. And notice Vince is gone, so we've got a vacancy over on the public side. It says first thing is closed session, even before we do yours today. Are we ready to just drop? I know you're not coming with us, Roberto. Are we ready to drop into closed session?
Drew, yes, Prabhu and I will stay out of it, but I just wanted to give you a heads up. I just received an email from Tom. He said he was running 5 minutes late. So I just wanted to let the board know. I think it will be okay if you go to closed session and, you can start just while Tom gets there, maybe start looking at the documents and preparing yourself for the process. And then when Tom makes himself available, I'm sure that he'll go to closed session. Does that make sense?
That makes perfect sense, Roberto. So Linda, whoever, go ahead and do what you need. Do the magic that takes us in a closed session. up by noon, so I'll say to everybody else, keep rolling right along. It's not a very long agenda. As always, jump in if you have temporal questions. If you have larger comments, wait until the presenter is done. I'll go round robin for comments, and then round robin if there are any votes. Let's see, orders of the day. Item 5.1C, Jill Fronte, police officer, police department, effective October 30, 2021, 26 years of service. There has been a change in the effective date from October 30th to January 8th, 2022, per Officer Franti's request. If I forget to mention that when I'm scrolling down the names, that has changed, and you know. I'm going to need a motion in a second. We're going to looking to waive sunshine for the amended attachment to item 4E that added the City Council's resolution on AB 361 to the attachment. Came in late. Do I have a motion to waive sunshine on that?
So move, Santos.
I have a motion by
Second.
Santos.
Second, Franco.
Second by Franco. Let's go around. Andrew, how do you vote?
Aye.
Rita?
Aye.
Howard?
Yes.
Shvar?
Aye.
Dick?
Yes.
Franco?
Aye.
And Dave?
Aye.
Ms. Chair Lands, I vote aye. That's unanimous. We've waived sunshine on that. We've got item 1, the consent calendar. Anyone want to pull anything off the consent calendar or make any comments about anything on the consent calendar?
Motion to approve consent calendar, Santos.
We've got a motion from Santos. Do I have a second?
Second, Wilson.
Second by Wilson. Let's go around. Andrew?
Aye.
Rita?
Aye.
Howard?
Yes.
Shvar?
Aye.
Dick?
Yes.
Franco?
Aye.
Dave?
Aye.
Chair Lands, I vote aye as well. Consent calendar is approved, which takes us into our main agenda. Over to you, Prabhu, for the CIO report.
Thank you, Mr. Chairman. Good morning, trustees. Today, we'll actually be talking about our annual fee report. And this is for calendar year 2020. And this is a report that we actually produce here at ORS and share with our stakeholders. And this is, just so everyone knows, this is one of the most comprehensive fee reports put out by any public pension plan out there. I believe there are only 3 or 4 pension plans that actually publish a fee report that's as comprehensive as this one. And typically I present this to the City Council in November. And so just presenting it to the board before we take it to the City Council. The boards have always been supportive of our approach and fully understand the reasons why we pay fees. And this is a report that I've actually presented to the City Council the last 3 years with Trustee Svinzeri. With that, I'm actually going to turn this over to David and Dinesh, who actually did the heavy lifting and put this fee report together. Over to you, David.
Great, Prabhu. Let me share my screen. Give me a second. Okay, can everyone see this?
Yes.
Great, thanks. Okay, so this is our, like Prabhu said, our annual fee report. I think most of you have seen it in past years. I think there's a couple new members on the board, so just maybe stepping back a little, just to give a very brief background on this. We've been doing this for around 6 years. It's a comprehensive look at the fees we pay to our investment managers. It's a lot more detailed and a lot more inclusive than what's on the CAFR, just because the CAFR really only captures fees we actually explicitly pay, and a lot of the fees that are paid to these investment managers are essentially deducted from the kind of NAV of the funds, and so it's very difficult to capture that outside kind of this effort. So that was kind of the incarnation of it. So basically, let's see here. So what do we want to say? There's two reports here. One is the longer fee report, and what I want to talk a little bit about is the presentation. The longer fee report has a bunch of tables looking at year-over-year changes, very detailed in terms of specific numbers. We kind of want to keep the discussion a little bit high level and focus a little bit on kind of longer trends. And so that's kind of why this is kind of the presentation we go through on an annual basis. Okay, so just going through the presentation. So before I start this, just want to again highlight the fact that the fees we pay are pretty much mainly a function of asset allocation, right? The asset allocation determined by you all, the board, and our job as staff is to most efficiently implement that asset allocation from risk-adjusted basis, taking into account fees. And so, this year's results, I mean, not much to report here. Our fees are pretty much flat. We've done a lot of work kind of bringing it down since 2017. But and that's primarily driven by, like we said, asset allocation changes, and also helped by kind of structuring within the specific asset class portfolios. So going to this slide, you can see fees have been flat from last year, but there's been a little bit of change in terms of where those fees have come from. We have lowered management fees a bit. Our incentive fees have gone up, and OPEX, operating expenses, have stayed relatively flat. On the right here, it's a attempt at a peer comparison. The caveat here is these numbers are pulled from the public plans database, which essentially is self-populated by the respective plans with essentially CAFR data. And like I mentioned prior, the CAFR data is not as comprehensive, and so it's just a rough kind of competitive analysis. Based on that, you can see we're kind of middle of the pack to kind of slightly below. Kind of put CalPERS and CalSTRS there as just FYI, not really comparable. One, given the size, and two, because of their size, they actually manage quite a bit of assets in-house, which reduces their fees quite a bit.
Hey, David, quickly, is that fiscal year 20? So that's a year ago, not the latest fiscal year?
Yes. So it's ending June 2020.
2020. Okay. So
Yeah.
we don't have the latest information.
Yeah. So, I mean, there's usually quite a delay in when people put it in. And so, yeah, usually it's,
Okay, thank you.
Hi, David. Sorry, I had another quick question on the first slide.
Yes.
The percentages on the first slide, on the left-hand side, like 12.1% and minus 2.9. What do they refer to again?
Yeah, so it's a plan return. So if you look at the kind of the little bar in the middle, that's kind of references what those rows are. On the left-hand side, first row, it's the return on a calendar year basis. On the right-hand side is return on fiscal basis, right?
Oh, no, wait. This is on the expense ratio chart, right?
Yeah. So you're talking about 12.1%, negative 2.9%, 13.9, and 13.7?
That's right.
Yeah, so that's the plan's return for that calendar year.
Okay. All right, thanks.
Are those numbers net of fees? 12.1? Okay.
Yeah. So that's another thing to maybe mention, right? Like all our performance reports are all net of fees. So really kind of, our performance reporting or Makita's performance reporting does somewhat incorporate this information to some degree, right? So just going back to our total fee number, and this is just kind of putting dollars in it. our fee ratios have stayed roughly flat, but we are actually paying more fees, and that's just a function of a higher AUM, given kind of the organic growth as well as contributions. So this is just this main slide we kind of want to focus on in terms of control what we can control, right? Because if you go back to the previous slides, it's management fee, incentive fee, and operating expenses, right? And like you said, fees are generally a function of asset allocation, and we try and kind of again, do the most efficient implementation of the asset allocation. And one of the ways we do that is through kind of portfolio structuring, active, passive, negotiating fees where we can. And so that kind of shows up in this management fee ratio to some extent. And over the last 5 years, we've been able to reduce our management fee by about 39 basis points, or $6.4 million in dollar terms. And what's that driven by? Primarily, kind of like we're saying, active, passive mix. And in terms of active, what we've been doing, or what has been done, essentially, first of all, through asset allocation, is a reduction in the hedge, I guess, absolute return, or now we call it market neutral strategies. I think we brought it down from, or the asset allocation has brought it down from about 6-7% to now 3%, which has reduced the contribution to active management fees from the hedged bucket, so kind of like that middle color, the bluish color. And from a portfolio structuring standpoint, we also got rid of essentially the hedge funds in our equity allocation, which also brought down management fees from hedge strategies. And you can kind of see that on the right, right? Basically, allocation to hedge strategies have come down, and the fee ratio and the fees we paid in those strategies has also somewhat come down. So that's pretty much it from what I had to present. I mean, there's that larger, more detailed fee report. If anyone had any questions on this or that report, we'd be happy to take it now.
David, this is Howard again. I think this is a good report, very good report. Thank you. Are there any particular asset classes? I know private equity venture might be hard to negotiate, but are there any things that jump out as like being difficult to negotiate fees? And are there ones that are more, amenable now in today's market?
I can jump in if I can. This is Dinesh from the investment team. Even on private markets, I would say I would agree with you that we're generally a price taker and there's not much room to make improvements on fees relative to the market rates. But there are a few specific areas we've been successful, and I can share a few of those. So first on negotiations, so things like using alternative consultants when it might be advantageous to us. So we typically work with Makita. However, we do have 2 other consultants that support us in other asset classes and other purposes, such as Barris with risk, Alborn with the absolute return program. So in cases where there might be a consultant aggregation benefit for being part of the aggregation with one of those alternative consultants, that's one thing that we've benefited from in some recent investments. A second one would be with scale. So there might be cases where we can reach fee break points and also expand relationships with new managers that might be launching newer products or be willing to work with us as a group that they already know us, we know them. It's a much easier process to work together on supporting new investments on their platform. And the third one is seeding newer strategies. So a younger manager that might have been a spinoff from a larger manager and providing capital earlier on, they might be more willing to give us favorable terms. And it might not just be for the first investment that we make. There's many cases where it carries on to future investments as well. And I would add that managers understand that fees are very important to us. They're aware it's something that we focus on. They're aware that we're producing this report that only a handful of plans are actually doing. And ultimately, it's the merits of the underlying investment. But in cases where all else is equal, we will focus on getting the best possible fee arrangement.
All right. Well, thank you.
Yeah, this is Laura from Makita. Oh, sorry. Could I just add something?
Go ahead, Laura.
I was just going to mention that San Jose, is sort of known in the industry now as being fee sensitive and a effective negotiator of fees, not at the expense of good strategies, but it's definitely something that managers are aware of, and I know that they need to sharpen their pencil when they're working with your staff.
And maybe just add one more to kind of what Dinesh was saying, just maybe as a addition to the point of scale. And I think, in some of our private market strategies, we also look at a little bit of out of favor strategies. And in those things where, managers have a little bit more difficult time fundraising, it's where we can kind of flex a little bit. And if we like the strategy, if we kind of think it's a good risk reward, we can, lean in and it's a little bit of leverage there.
I like it. Value oriented. Thank you.
I didn't have a question, but I was just going to say this is a terrific story to tell for sure. Returns have gone up and fees have come down. So.
Okay, well, I guess if no one has any other questions, then maybe hand it back to Prabhu.
Thank you, David. Thank you, trustees, for your excellent questions. We are very fee sensitive, as you would have gathered from the comments made by staff, and we try to continually improve this report and improve our performance in fee negotiation, and we report this out every year to the boards as well as to our stakeholders. And by the way, since Trustee Sanzeri is not here anymore, this is an open invitation to any trustee to accompany me to the City Council meeting next month to present the fee report along with me. So let me know if you're interested. Mr. Chairman, with that, actually there's one more piece of information I do want to share with the board, and that is fiscal year-to-date performance. This, Mikita just passed this on to me as of the day before. The pension plan returns were flat fiscal year to date. This is from July 1st, and healthcare trust was down 1%. With that, I'm happy to take any questions.
How does that compare to other plans over a similar period, Prabhu?
Oh, comparison, yeah, I don't know if Laura has any information. I think it's a little early. We just finished the last quarter. I don't know if that information is available yet. I will ask Laura if she's still on.
Yes, that's correct. We don't have peer returns yet. Let me just look very quickly here at some of the benchmarks. If we looked at a 60-40 global, it's going to be pretty close to where you are at about flat for the same time.
So the overall market's roughly flat. We're roughly flat, which means anybody else will probably be roughly. That's great, Laura. That's what I wanted.
Sure.
That's why we drink beer, Laura. So it's not 3.2. Yeah. It's just somewhere between 1 and 5. Anybody have any questions for Prabhu or Laura or the staff? Great. Thanks, Prabhu. We have no old business. We sort of wrapped up pension obligation bonds, which was a big ongoing thing for the last 4 or 5 board meetings. New business. Over to you, Roberto.
Thank you, Mr. Chair. So if you bear with me, just a couple of minutes, my monthly audit report. Let me start with an update on staffing. We just welcomed a brand new benefit analyst to our benefit staff a couple of weeks ago, Michelle Seychelles. She actually came to us from another department within the city, so she's well versed through the city procedures. So we're very excited to have her on board. Unfortunately, on the other hand, we lost Peter Fan. Peter actually was our network technician. Many of you probably worked with him when you were receiving your iPads and everything else. I know staff was, he was working diligently over the years with us, especially when the pandemic started and we bought laptops for everyone. So his last day was last week, and he actually took a position with another department within the city. I also want to let you know that we have a presentation to be made next week to the Association of Retired Police and Firefighters. It's mostly related to the healthcare. Health open enrollment is scheduled for November 1st through November 30th, 2021. And just as we did last year, this year is going to be virtual. We will not have the open enrollment in person. So we will be sending out packets to not only cards announcing to our members, but also the open enrollment packets later this month. And certainly we will have information on virtual presentations by the various medical benefits offices. And of course, we will have information from members to reach out to in case they have specific questions about the process. The quarterly newsletter will be coming out in the next couple of weeks. And lastly, I just wanted to kind of give you an update of where we at, not only from the city standpoint, but also from the Office of Retirement Services in regards to the mandatory vaccination program that the city initiated, which is now in stage 2. As of September 30th, they actually require of all employees that they either needed to be vaccinated, or if they were not, they were the hopes were that they were in the process, or if they were not going to be vaccinated, they needed to then file under one of the two exceptions, the religious exception or the medical exemption, in addition to providing twice a week a test informing the employer that they are negative in terms of COVID-19. And so the city kick off that process. Obviously, this is October 7th. They have been very clear that their goal is not really to terminate employees, but and they will be very flexible in terms of, and so will we, in terms of the process. If our employees already initiated their process to get vaccinated, we will work with them to make sure that they complete it. But for those cases, which we expect them to be the least, where they just not are in line with the updated requirements, there are specific requirements in terms of if they're not willing to meet the request by the city, then they will eventually put in some sort of a probation, following with suspension, and eventually termination if we are not able to work out those differences. Lastly, I wanted to mention, originally the city had estimated a timeline to return staff to the worksite October 1st. Because of the Delta variant, they moved up that date to November 1st. But they also try to make sure that they provide the employees at least a 30 days heads up when they expect them to start migrating back to the worksite. It's already October 7th. At this time, the city is still using November 1st as their deadline. But again, they haven't completely decided that it's going to be November 1st for a couple of reasons, but one of which is they wanted to make sure they gave employees a 30 days heads up. We in the Office of Retirement Services are doing a couple of things. Not only, certainly, we are following up and trying to match to the extent that that's possible for us, whatever requirements the city is asking of their employees. This is also because many of our employees are on the bargaining units that have specific agreements with the city. And in addition to that, I wanted to share with you that we do have a skeleton, a crew in the office. We do have some employees working on a project They are just a handful, but we do have someone since last Monday. The office remained closed, but we do have someone in the front desk answering phone calls. We are also working on implementing an appointment system. Initially, the appointment system is to make sure that members can make appointments, but these are to be virtual at first. Ideally, eventually, once we implement this appointment process and we start considering opening the office, then we will make sure that we work our appointments staggered throughout the day with members if they want to come to the office. Bottom line is, we're still not sure when the office is going to be reopened. We do have a skeleton crew working. We try very hard not to have more than 10 employees at the office. And so I will certainly keep all of you posted of whatever final plans we follow. Your next meeting is, I believe, November 4th. So I certainly could have an update for you at that point. But rest assured that our overriding factor here is the health of our members and our staff. And we want to make sure that when we decide to just go along with this plan and implement it, that we are responsible, again, for our customers and our team. At the end of the day, that's what we want to make sure is that we're able to serve our members. So to the extent that we can do that remotely, we will probably continue doing so, although certainly we understand that the office need to be open at some point, which we expect to do in the next couple of weeks, in the next couple of months, but again, we will keep you posted. Lastly, I just want to close it by saying that when we do start getting back to the office, we certainly will follow a hybrid approach. So we don't expect to have all the members and all the employees here at the same time. Remote work is here to stay, so we will support that as much as possible, but certainly making sure that not only we make sure that our members and staff are primary health was paramount to us, but making sure also that we can serve our members in an efficient and effective manner. So with that, Mr. Chair, that concludes my comments, and I'm happy to answer or address any specific questions.
That's great. Thanks, Roberto. Very helpful. Floor is open. Anybody want to discuss any of that? If not, it dovetails. Let me see. Pam, if you're out there, you want to give us a report?
I am. I'm here. Thank you, Drew. Thank you for all of you who were able to participate in the study session. I think it was last week, although time seems so irrelevant these days. But the study session was interesting, informative. The City Council did move to go forward into the validation process. There were some concerns on the council part about risk, which was stated very clearly and eloquently by the trustees and also by some of the council members. And I did approve moving forward with the validation process, but that doesn't mean that when we're ready to issue the bonds, that I'll be ready to say yes at that point. There's a tremendous amount of risk, and the question is the upside. So I really am going to look to the pension board for your guidance and advice as we get closer to this. So maybe, Drew, I could sit down with the investment committee or somebody and a group and pick your brain a little bit, because I've heard your discussions. I've heard the council's discussions. It's a very complicated issues, but I'd really, as trustees, you're and the ones who are going to get the funds if we issue the bonds, what are your concerns? What should I be thinking of when I move through if I decide to go say yes or no when we're ready to issue bonds? So I could really use your point of view, and I know that your point of view is a little bit different because we're going to give you the money and then you're going to invest it. But we're talking at the city level, will you execute an MOU as to how the funds will be invested? that sort of thing. So I would love, maybe we can sit down. It doesn't have to happen today, Drew, but put that on your calendar for maybe spring, early next year, fall or winter, to sit down and have a conversation, because I would find it very helpful. Validation takes around 7 months, it sounds like, a long time. So that's one thing very much on my mind and of concern because of the high risk. As you all know, the city is responsible for the bonds, making the payments. We just want you to generate a yield that gives us a benefit for having those funds to invest. The other thing I wanted to let you know is, and I appreciate your sensitivity to fees. You know, the city council is very sensitive to fees, and I appreciated the report. It was very helpful. Also, I just want to let you know that we are working on, really focused on homeless housing. On Tuesday, we approved the acquisition of 2 motels that we will be rehabbing and moving unhoused individuals into. And some of them are targeted for families and also children, foster youth and homeless teenagers. Also, we are looking at buying, we have land and we're going to build some bridge housing on Branham and Monterey Road is one bridge housing project. We received a large donation from Sobrato Foundation that will help us, and Life Moves will be the provider. These facilities are really nice. I toured them the other day, and they really are nice units and well run, a lot of supportive and wraparound services. Each district will be required to host a bridge housing property. In District 9, that's harder to do because we don't have a lot of open space. We have a lot, there's a lot of infill that is not available in District 9. So I have to figure out an area that the neighbors aren't going to be overly concerned about it, and then make sure they have a good sense of what those properties look like. I just wanted to share that with you because I know you're hearing, like everybody, and you drive through San Jose and you see a lot of encampments and maybe wondering what the city is doing about it. I just wanted to share that with you. So with that concludes my report, but I'm interested in hearing your economic assumptions discussion or anything you want to share about POB, but I know you said it's old business. Not for me, Drew. It's still old. It's going to be around for a long time.
Oh, God, yeah. Let me go ahead and use Chairman's prerogative to jump in, but what I'm going to tell you now is not as a board member and not as chairman. It's just a old guy with degrees. The city is not approaching the risk of POBs correctly, in my opinion, not as chairman, not as a board member. I think you're right, Pam. It really comes down to risk. And I tried to say it in that meeting. Historically, if the future is like the past, there is no risk to doing this, right? There's never a period since the Great Depression where this would fail. So the question then is about unknown risks or risks where the future is not like the past. Turns out there are people that do that for a living, and there are ways to get at that. And I think it's very easy, Pam, well, I used to take, come once, to go to the city and say, here is the panoply of risks. Are you willing to accept these risks? Now, again, the risk for the future is not like the past, but we can still get at that. Are you willing to accept this risk and do this? I think that's quite doable. And then I think the council is a pretty straightforward decision, right? Well, everything in life is a risk. Is this a prudent risk?
Right.
And for some reason, I don't know why you're not getting at it that way. Well, I mean, I'm an engineer, right, Pam? So when all you have is a hammer, everything looks like a nail. And so what I have are tools that allow me to analyze statistics and risk, and it can be done. And I think that's right, because the part where we do it, and we're very happy to, I think, write those memos to you, Pam, is pretty straightforward, right? If you say to us, well, give us 2 answers, guys. If the future's like the past, what would you do? And Prabhu and his team can figure that out based on historical data. If the future's not like the past, guys, how do we work together to mitigate those risks? And that's not a we write a memo saying what we're going to do. That's a we work with you and write a memo saying how are we going to work together as this uncertain future unfolds over the next couple decades. Does that make sense, Pam, what I'm saying?
It does, and you know, I'm in the mortgage business, so I look at this POB as an opportunity to lower our debt and benefit from the yield. That's the risk, is that we make a dumb decision and we the discount rate that you're utilizing is too close to the rate of the bond. That's a dumb decision. But if it's a delta of 3%, makes sense every day. When I'm refinancing someone, I look at 1%. If they can benefit their rate by 1%, it makes sense to them. So it's kind of, I kind of consider that. So when I consider the risk, personally, I don't see a huge risk because we're not going to make the decision if it doesn't make sense financially. Yes, the city is on the hook, but we're already on the hook for the unfunded liability. So I don't know. I mean, that's my simple brain trying to grab a very complicated issue that I've tried to research as much as I possibly can, but that's how I see it. I don't see it as a big risk, but I see it as like you said, mitigating the risk. How do we mitigate the risk, and what's the benefit to the city? The benefit is to the city is that we save money, right? Over the long haul. That makes sense to me, but
yeah, no, I think it's, let me jump in. I think you're right, Pam. And we had started before the POB. We started with my chairmanship. What I have a theme as a chairman. It's my theme. How did we sort of get in this dilemma by a risk that we didn't see coming? And part of that is, of course, inflation being this weirdly low thing. And you're in the mortgage business, so you get that, right? And we're working on sort of how do we tackle that? And that, by the way, is the risk to the POB. And so all these things tie together. And this goes back to, you know, we were talking about years ago when you first came on. We can handle historical risks. That's trivial. It's these unknown future risks that are tricky. And that's, I think, what we should be dealing with as we try to figure out what risk you can tolerate, therefore, what risk is appropriate to us to put on you, and so on. So the floor is open. Anybody want to jump in on the POB discussion or anything else with Pam?
Yeah, I think.
Go ahead. Yeah, sure. Go ahead.
Yeah, so I think what you say about you know, getting a mortgage is a very good analogy, because you know, if you're suggesting something to somebody who wants to flip the house in a year, you know, it's a toss of a coin what happens, right? I mean, you know, prices go up or down, but you know that if the person stays with the home for 20 or 30 years, chances are it's a very good investment. I think it's the same thing with, you know, kind of this diversified portfolio that we manage, which is, as Drew said, you know, over the long term, it's the probability that it's going to do better than the 3% or whatever interest you pay is very, very high. It's not certain, but it's very, very high. So for me, that's the exact reason why, you know, you should just view it as, you know, a long-term investment with a very high probability that it does better than, you know, the interest rate you're paying.
right, and thank you. I personally, I had an adjustable rate mortgage on my house, and most of the time I was way below the market, but every time interest rates dropped, I checked to make sure that I was. Once in a while, I was slightly above it, but overall, over the 30 years of my mortgage, I was way below and I benefited by it. So it didn't make sense for me to refinance at all, because that 1 year that I was above it, every other 29 years I was way below it and I benefited from that. So I don't, that's how I think about this, is what is the benefit? And the rate is what, 3% or something right now, I was told. So if the discount rate is 6.625, it's a better deal, right?
Yeah.
At least that's the way I look at it. So, but thank you. I really appreciate this conversation. I was hoping to get into a little bit this But Drew, I don't want to monopolize your meeting because I know you've got a big agenda, and it's just something I need to address and think about. And I appreciate any conversation that we can have today.
Yeah, no, let's keep the floor open. I think it's interesting. Yeah, Prabhu, Roberto, any other trustee want to jump in? And you know, I think kind of give your own opinions. You don't have to speak for your office, right? This is as much us bringing our individual experiences to a debate as anything else.
Mr. Chair, Dave Wilson has his hand up.
Go ahead, Dave. Just jump in. Go ahead, everybody jump in. Jump in, Dave.
Yeah, I know I'm the new guy, so I'm just asking for some clarifications. We keep talking about it over the long haul in 30 years. However, we've also seen that in 8 years, 9 years, I think it was, that police and fire is going to be fully funded if we meet all our goals. So I don't understand why we're talking about a 30-year as being profitable when we should be looking more in the short term, because if we meet our goals in 8 or 9 years, we'll be fully funded. So in my opinion, if we talk pension obligation bonds, it should be on that shorter schedule than the 30-year mark. I'm again new to all this, trying to figure it out.
Well, Dave, I'll let those more knowledgeable answer that, but I'll address it a little bit. It's not just the police and fire, which may be fully funded. It is the federated board or federated employees, which are not fully funded. I think they're, and Prabhu probably can speak to this better, they're closer to 50% funding. And that's where the POBs may benefit more, is in that pool of funds is the federated employees. And then there's the huge $1 billion of debt that the city already owes in related to unfunded liability. Anyone else have any?
Yeah, I think the one thing I would say, Dave, is that you know, if you take a shorter time frame, there is the assumption that you get the 6 5/8% compounded annual return, and the probability that you do get that is lower than if you take a longer term time frame. So yes, ideally things work out, but you know, as Prabhu said, you know, markets are, you know, richly valued. I would agree with that. So I think we should, you know, we should go in this direction with the view that over the long term, this really works out. Over 5 years or 10 years or 8 years, you know, it probably does, but the probability is lower that it does that, you know, you can always have an event that, you know, is adverse.
So if I understand you correctly, Eswar, if we do look at the shorter term, the risk is higher than the long term. Is that what I got from you?
That's correct, yes.
Yeah, if I can add something, Mr. Chairman, since Trustee Wilson brought this up. Yeah, so we did show some data last week at the joint meeting, and Chairman Lanza has been pretty vocal about this, that over a 30-year period, anytime you put money in the market, even if it's the S&P, and we don't put all our money in the S&P, we actually run a diversified portfolio. But even if you do that, which is a riskier asset class than a diversified portfolio, over a 30-year time period, we always come out ahead, even over the discount rate. But as Trustee Wilson pointed out, what if your time frame is shorter? And that's an important question to address as we move forward. And we showed data that over the last 150 years, there have been multiple time periods when over a 10-year period, you would have actually lost money. And the most recent one being, if you'd invested in 2000 and taken it out in 2009, 2010. And so those are important things that we should continue discussing, you know, as we get closer, you know, to issuance. And I'm sure we'll have multiple discussions at the IC and at the boards and with the city.
Floor's still open. Anybody want to jump in on this?
Great. Thank you.
So Pam, final thoughts. So we have that great thing, Vince was part of, Andrew, you know, Prabhu was, Roberto on there, where we kind of, let's look at POBs, right? And it's almost like we need those sort of for risk. So we think we want to do POB. You said it right, Pam. If I can get 3% above, it's a no-brainer. Historically, it's a no-brainer. How do we sort of engage this uncertain future risk? I was disappointed by the consultants. And I got to get on a phone and maybe talk to them, because obviously they deal with this every day, and they must know something I don't know because they didn't get into it. And maybe what I'm saying is the same thing. Maybe they're thinking, look, you kind of agree you want to do it, and then we start dealing with risk and implementation, right? It's almost like we're saying, I'm not sure I want to do it until I understand the risks, but I'm not sure we're really going to dive in and understand the risks until you say, yes, let's burn the cycles, do the homework, do the study. I think we'd like to do it if we can get those, as you said before, Pam, those risks understandable. Anyway, happy to, Pam, we're happy to help any way we can.
I appreciate it. Thank you. I'll talk to the city staff to see if I can get their take on future risk, because you're right. That is, historically, you were very clear about the historical data and how there's no risk if we look at history. Of course, we can't predict a crash like 2008, although some of us in the mortgage business, we were really concerned about it. But I'm just a small broker with 6 employees. What do I know? I don't know what Wall Street knows. That's for sure.
Chairman Lanza, if I may add, just to clarify, when you said you were disappointed with the consultants, just for the record, you were not referring to our investment consultants.
Oh, no.
No, I know. Yeah.
Yeah. And they're really sharp and really good. So I'm guessing they're saying we're not at that point in the process yet. And if that's true, then we should be listening to them. And I'm guessing that's probably right. They're probably saying, well, before we burn all this money and cycles and time analyzing that risk, why don't you tell us you're interested?
Right.
And I guess City has said they're interested.
Well, we have now. We approved validation process. So now the paperwork begins, and then we'll watch the rates once we get validated. But even after validation, someone could challenge the decision, and then we're involved in appealing the decision, and that could take even a year, could take longer. So we may be a long way away, and the market could shift dramatically in that year.
Great. All right. Thank you, Pam.
Thank you. I appreciate it.
Over to you, Anne, for item 4C, economic assumptions. I saw Anne. Oh, hi, Anne. Over to you.
How are you?
Good.
Good. I can share my screen here and pull up the presentation. Hold on. Actually, hold on. Let me find it. Okay. Okay, there we go. Okay, good morning, everyone. I'm here to go over with you the economic assumption review. And so to start, before we go into that, we're going to go through the schedule or timeline, if you will, of projects for the valuation cycle for the June 30 fiscal year. And then we're going to look at the preliminary projections, which most of you have seen when Bill showed those at the joint board and city council meeting last week, which is reiterating some great news from the investment returns. Then we're going to review our analysis on the plan's economic assumptions. And finally, we'll get to some discussions and some possible decisions from the board. As you can see, there's lots on the docket for this year, and I just wanted to highlight a few that are new this year. And this is both for the pension and the OPEB valuations. So in November, we have a demographic experience study that we're going to be bringing the results forward. And then also we have another actuary, Siegel, is auditing both the pension plan and the OPEB plan for their the 2021 valuations and experience study that are in process right now. So those are new this year. And today, you know, as I just said, we're going to go over the economic assumptions. And then in November, the demographic experience study. And then in November, we'll have final decisions, or we'll need final decisions on these pension assumptions. Moving on to December, we'll present draft valuation results for the pension plan. And at that time is when you'll be reviewing your OPEB assumptions and making decisions on them. In 2022, in January, is when we'll present the final valuation report for the pension plan. We'll have draft OPEB valuation results, and then Siegel at that time will present their results on our pension valuation. And finally, in February, Siegel is going to present the results on the OPEB audit, and we'll have the final report for the OPEB retiree medical plan. And with all of this with all of these items in the schedule, you can see that the OPEB plan generally lags 1 month from the pension plan. So moving on, here we're showing the projections of the update of the projections from 2022 with that extraordinarily great investment return of about 27.5%. So what we're seeing here is the projected unfunded liability on a market value basis, meaning we're looking at this from the market value of assets, not our smooth value of assets. And the 2020 projection is that blue line. And you can see there's a dramatic increase in the expected unfunded for 2021. It's more than a half. UAL has cut more than half for 2021 based on those investment results. The funded ratio here at the top, you showed 71% in last year's valuation, increasing all the way to 87% because of that decrease in the unfunded accrued liability. The pension plan is expected to reach 100% funding in 2029. And this is 10 years earlier than the 2020 projections were showing. So really a dramatic change in the landscape of the police and fire pension fund due to those asset returns. However, in 2021, the 2021 valuation, we also have two other components that are going to affect those results, right? The potential changes in the actuarial assumptions, and we're also going to update the census data or the participant member data for 2021. So there are a few more elements that go into the valuation. And so these are not the final results here. And just to note that there could be significant potential variation in these projections. I know the market is flat right now, which in some people's eyes is good news because there's skepticism that the market could revert again and maybe take some losses. So being at a flat level right now, I think is kind of holding the line with these returns. I see that Harvey has raised his hand.
Yeah, thanks, Anne. And sorry to interrupt you, but it seems, I'll just have to be frank, it's on behalf of the board, it seems particularly confusing, frankly, if not misleading, to base all the actuarial determinations on smooth actuarial value of assets, but to show in this projection the impact of the market value on the funded status when none of the actuarial assumptions or projections will be based on market value. They'll be based on actuarial value, which is smoothed over time. And so I just want to call that out and have you explain why you're showing market value instead of actuarial value that's smoothed over time.
Okay, no, that's a great point, Harvey, and I can clarify that. So when you're looking at these projections on a market value basis, it's only the first 5 years where the results are going to be any different than if you look at an actuarial value basis. So for instance, all of the funded ratios past 2025 are going to be the same on a market value and actuarial value assets, because we're smoothing those assets in over a 5-year period, right? So after 5 years, they're the same in our projections, because we're assuming the fund is going to earn its expected rate of return each and every year after 2021. So that's just kind of big picture of the projections. And also I can say that on an actuarial value basis in 2020, the funded ratio was 74%, and it will increase if all the other assumptions are met and there's no assumption changes, will increase to 78%. And then it will be 87% by 2023. So you are still seeing very large increases, even in the funded ratio on an actuarial value basis as well. And we can come back and show projections going forward too in next month's presentation, if you prefer to show some of these results on an actuarial value basis. But again, they would look the same after 5 years in the picture.
I would agree with Harvey. I think it's important to keep us grounded to see the actuarial value chart as well.
Sure.
So we're not
Okay.
missing something.
Yeah. Definitely. Point taken. Yeah. And that's not a problem. We can do that.
And would it be fair to say, just a question following up on that, that if the main difference would be that besides the smoothing, is the assumption that the reinvested returns are going to continue to earn a 6 3/8? Is that our 6.625%? Yeah.
Yeah, 6.625. Yes. So in this projection, the only thing that we're changing from the 2020 projection, which assumes that each and every year the fund is going to earn 6.625%. We did incorporate the 27.5% return for 2021. And each and every year after that, we've assumed 6.625%. Correct.
Actually, wait, can I restate my question? I always hear Prabhu saying, "Oh, we got this big inflow from returns." So whether it's actuarial or market value, does it matter that just increases the asset base for future projections? Or are you smoothing that over time as well in terms of when that asset flows into the base of assets that we're earning?
Right. Okay. So on the market value, there's no smoothing there, right? So you're seeing these projections right here with no smooth assets. When we do actuarial value projections for assets, we only recognize 20% of each year's gains or losses in 1 year. So over 5 years is when that asset gain or loss in this circumstance, this large asset gain, it's recognized over a 5-year period. So only 20% is being recognized each year. So that's why when I said after 5 years, the funded ratio is going to be the same for the market value and actuarial value, because all of the gains have been smoothed in.
Got it. Thank you.
Does that answer your question?
Yeah, it does.
Great. Are there any more questions on this slide or comments? Okay. Yeah, thank you for that input. So here we're showing the updated contribution rates with the investment results from 2021. And here you are seeing the contribution rates are being calculated based on the actuarial value of assets. So the 2020 projection on the left-hand side here, you can see that there was a gradual decrease expected in the contribution rates, and then a more accelerated decrease in those rates. And this is mostly due, the smooth pattern is based on a couple of years ago when the board had decided to adjust some of those amortization schedules. So you weren't getting these peaks and valleys or cliffs, if you will, and it was just more of a smooth pattern for these rates. But because of the 27% return, you can see that the projected contribution rates have dropped significantly. And you don't see a significant drop that first year because only 20% of those gains are recognized from 2021. And here at the bottom, this is the fiscal year where those contribution rates are expected to be made because the 2021 valuation is the basis for your fiscal year end 2023 contributions. So you can see that it drops to 81%, the contribution rate from 87 to 81. And then it's just a slower decline as those investment gains are phased in over time. And then you're down to about 50% when those gains are fully recognized, and you just have like a more gradual pattern that looks a lot like the projections in 2020, except at a much lower level. There's a similar pattern for the projected contribution amounts. And again, they're well below the 2020 projections. So moving on now to the economic assumption. This is the crux of today's presentation. For board members, the newer board members, I'm just going to reiterate some of these things that some of the more seasoned members are familiar with, but this economic assumption, we do this every year. And then we do a demographic study is performed every 2 years. And a demographic study is more looking at member behavior, such as retirements and terminations. And we're going to present the results of our study on that in November. And as I said in the last slide, is that the assumptions adopted for the 2021 actual evaluation are going to be used to determine contributions for fiscal year 2023. So we're going to be looking at price inflation, wage inflation, the amortization payment increase rate, and the discount rate. And the discount rate we're only looking at for the pension valuation because the OPEB assets are invested separately and they have a completely different asset allocation, so they will not have the same discount rate. So the focus of today's presentation, which isn't unusual, is going to be on the discount rate, as that's really that's the only assumption that we are proposing any potential changes to. So that being said, I am going to summarize and share the key findings of our analysis for the other economic assumptions. And the first here is price inflation. So price inflation is the foundation of all the economic assumptions, the wage inflation, expected return, and the ultimate healthcare trend, which is used in the OPEB valuation. Currently, our price inflation assumption is 2.25%. As I said, we are recommending no change to that assumption. It does have very limited direct impact on the valuation since the tier 1 COLAs are fixed at 3% regardless of inflation. Tier 2 COLAs do depend on inflation, the Bay Area inflation, with a maximum of up to 2% increases for their COLA. So our assumption there is the 2%, and we know in some years it may be less than that. So we have a conservative assumption for the COLAs for tier 2 members. So again, there's really not a direct impact on the valuation for the price inflation assumption. The graph on the left-hand side is showing a survey of price inflation price inflation assumptions. On the left, we're looking at economic forecasters and actually the Horizon survey. And the Horizon survey consists of almost 40 different investment consultants nationwide. So on the left-hand side, you're getting the forecasters and investment consultants' opinion on what inflation is going to look like in the future. And that ranges anywhere from about 2% to 3%. And then looking on the right-hand side of the graph here, you can see the one chart is the public plan database. So that's the national database of public sector plans and what their assumptions are for inflation. And then in the very right-hand stack of colored bars is the California survey, which is about 39 California systems. And you can see that these assumptions are just slightly higher than the forecasters, and there's a slightly wider range when you look at the assumptions nationally. The gold bar or the gold diamonds are San Jose's inflation assumption at 2.25, and Makita's inflation assumption is just lower than that at about 2.1% for their 20-year outlook. So really closely in line with that. The right-hand chart is showing the break-even inflation, which is really a market forward-looking indicator of what inflation is going to be over, like, in this case, we're showing a 5-year horizon and a 20-year horizon. And what's interesting here is in the short term, as of June 30th, 2021, the expectation is higher. The short-term expectation of inflation is higher than the long-term expectation at 2.5 versus 2.4, which implies that the market is assuming that the higher inflation expectation may be just temporary. The last thing that this break-even inflation chart is showing us as well is how volatile the expectations of inflation have been in the last year and a half, mostly due to COVID and the impacts on our economy there. So the next assumption is the wage inflation assumption. And this can be thought of as an annual across the board salary increase for active members. And it's also can be looked at as the minimum individual increase for the active members. And currently the wage inflation assumption is 3%. And we believe that this is still within a reasonable range and are not anticipating or are not recommending that this assumption be changed. Here we have a little bit of data on the wage inflation. We are considering the recent bargained agreements for both the police and fire in our wage inflation assumption. For this coming year, we're assuming that the police active members will receive increases of about 3.8%, whereas fire is their bargained increases are 4.25%. So those assumptions will be programmed right into our valuation instead of the 3%. However, for fire, their bargained 3% increase for fiscal year end 2023, which is really an indicator of where things may be settling. So again, that 3% wage inflation assumption is consistent with those bargained agreements, the longer term bargained agreements. So in our California survey, the range that we were seeing is of wage inflation is 2.75 to 3.5. So again, within that range and very reasonable. And our chart here over on the left, on the right-hand side of this chart, you're seeing the San Jose Police and Fire history of over the last 5, 10, and 20 years. And it's all that historical information is also showing around 3%. So we are not proposing any changes to this assumption based on the data and what we think things look like going forward. So before we move on to the discount rate, we'll talk about the one last economic assumption, which is the amortization payment increase rate. Typically, we see increasing UAL payments in public sector plans. Also, typically, we see these set as a level percentage of payroll, so that when payroll is expected to increase by a certain amount, so are those amortization payments, so that as a percentage of pay, those payments are level. However, San Jose Police and Fire, we actually have the UAL payments increasing at a lower rate at 2.25%, so that it's more in the intent of this, so that it's more in line with the city's revenue growth. And it's a little bit more conservative because if pay does go up by its expected 3%, and your amortization payments are going up by only 2.25%, you're going to see those UAL payments as a percentage of pay decline over time. So anyway, we are still recommending that we maintain this assumption of 2.25% in line with inflation, and then also our expected inflation, and also in line with the expected city revenue growth. Okay, so moving on to the discount rate. As everyone knows, this is the most powerful single assumption that is in a mature pension plan. And since there are only two ways for the pension plan to receive money, it's either through contributions or investment returns. If you set the expected investment return higher, you're going to have lower expected contributions and vice versa. But over time, it's not the investment rate of or assumed investment rate of return that's going to have the impact on your plan and the cost of your plan. It's going to be the actual investment returns. So in some ways, this discount rate can be looked at as a budgeting tool, if you will. And the current discount rate is 6.65%. There's a couple ways that we look at setting the discount rate. We look at historical experience and industry trends. However, that's just important for context. The primary factors that we look at are expectations for the future. Like, what do investment consultants see the markets doing? And we also look at the board's risk preference. And when we're looking at the board's risk preference, it's not in terms of asset allocation. It's in terms of how likely do you want to be exceeding your target return, and how often do you want to be, above that return every year or below that return. So it's not about the asset allocation. We're talking risk in this context. So here we're looking at the historical performance for San Jose Police and Fire. And what's really stands out is the very last year in 2021 of those returns of 27.5% on a market value basis. Another way to look at this is you really got 4 years worth of returns in 1 year based on the 6.625 that you're expected to earn each year. And so you're seeing only 20% of that being recognized for 2021, but your actuarial value return is higher than your assumed rate of return at 9.6%. And there's only been one other year in this time frame that we're showing where the actuarial value of assets returned more than your assumed rate of return. And part of that is due to the fact that in 2008 and 2009, there was a market crash. So some of those losses were being phased in over that 5-year period. So it was a drag on the actual value return in those years. But again, just to take away from this graph is the returns for 2021. So looking at the industry trends, here we're looking at our Chiron survey of California systems. There's about 39 public sector systems in this survey. And over this 11-year period, you can see that the trend has been downward with the discount rate, with San Jose leading the pack, if you will. Always either the lowest discount rate within all the California systems or in the lowest 25th percentile. On the right-hand side is the survey of 2020 valuation assumptions. We don't have all the 2021 assumptions yet. Everyone's still in progress working on the valuations, but with the survey in 2020, you can see here's San Jose, both the federated and police and fire system at the lowest level, except for the 6.5% where there are two systems lower than that. And the most consistent, or the return with the highest number of systems added is 7% return. And what we're seeing though with 2021, based on these investment returns being as high as they are, is there's a lot of systems that are taking the opportunity to lower their discount rate at this time so that you have those offsetting investment gains, so that that actually puts downward pressure on the contribution rate. So basically, and taking advantage of those returns so that the contributions stay the same, but yet you've actually lowered the discount rate.
So Anne, are you seeing that as an 1/8 of a point or a 1/4 of a point drops? What are you kind of seeing?
That's interesting. So more quarter of a point drops. I think there's 20 systems in here that are 37X systems, the SACR systems. And they tend to go down with their discount rates at straight 25 basis points. So we know of at least 5 or 6 systems that are dropping from 7 to 6.75%. It's the cities like San Luis Obispo County, San Jose, San Francisco. These plans tend to look at the discount rate not in terms of 25 basis points, but it's more fluid and it's more independent of that norm, if you will.
So if you showed us this chart next year, you might see the bars at 6.75 and 7 being closer to the same height.
Right.
Right. Thanks, Ann. That's great.
Yeah.
Drew and Ann, I just wanted to share with you the county next to us, to Santa Clara, San Mateo. I believe they actually went down to 6.25 for 2021.
Yeah, so they were at 6.5, right. And I do know of one plan going from 6.75 all the way down to 6 as well. That is a closed plan, so they have a much different asset allocation, which warrants that drop. But you definitely are seeing a lot of systems taking, if you will, advantage of the investment returns to lower their discount rate. And it, as I'm going to show in the next few slides, the forward-looking aspects of what the market's going to do from the investment consultants has also dropped. So that really warrants or could warrant a decrease in the discount rate as well.
Ann, could I ask you a question?
Sure.
Thanks. Just as an educational matter, briefly, would you be kind enough to educate the board on the difference between the discount rate, being the rate at which we discount the present value, the expected liabilities in the future, and compare that to the assumed rate of return, which is the rate we expect our assets to grow, and why those two numbers have to be the same?
Well, that's an interesting concept. In the private sector, they're not necessarily the same because by statute, they are dictated what they have to use to discount their liabilities. But anyway, talking about the public sector, we use discount rate and assumed rate of return synonymously, right? So when we look at the liabilities and we look at our projected benefit payments, that stream of benefit payments, when we're calculating the liabilities, we need to come up with a rate where we are going to discount those to the present value and what the value of those dollars are in today's dollars. And we always discount those expected benefit payments at the expected rate of return, just so that it's consistent with, with liability gains and losses. So they really just are synonymous concepts. The expected rate of return is looking at the portfolio, looking at what you are expecting your assets to earn, and I'm going to go through the process of what we look at and how to determine what we think the expected rate of return will be on our assets. And then once we determine that, that's what we use in our valuations to discount those liabilities.
So I guess my question is, why do you use that same figure to discount liabilities? What does the growth of the assets have to do with the present value of the liabilities?
Well, it's looking at trying to set contribution rates that are consistent with how we think the assets are going to grow, right? So we're setting contribution rates based on the actuarial liability, correct? So try to put it in clearer terms, is that if we're expecting the assets to grow at a certain rate and we discount the liabilities at a different rate, you could have some generational inequities in terms of where what you're setting your contribution rates to be. For example, let's say you just do an extreme example. If you had an expected rate of return in your assets to be something like 4%, right? But you discounted your liabilities at something like 10%, you're going to have liabilities that are much lower. And then resulting contribution rates are going to be much lower. Yet you're expecting your assets to return a different amount than your discounted liabilities. So it's just a matter of maintaining what you're expecting in the marketplace. Does that answer your question?
Not sure. I'm not. I just want to make sure the board understands those two levers and what their relationship is. And when we use the phrase discount rate, that you're using the same rate at which you expect your assets to grow to project what your liabilities are going to be. That's all.
Right, because if there's a disconnect in that, then you're setting your contribution rates on something that's not how you're expecting your assets to grow. Right.
Let me jump in. The way I think about it, and this may help the board, is, and explain exactly right. The number's easy. It's not just a number, right? And it's volatility and uncertainty. And how certain am I those payments? I mean, the bad news for San Jose is we have too many retirees. Good news for San Jose is that means not a lot of volatility in that damn number. They're already retired, right? And so you're trying to not just match the number, you're trying to match the risk, the uncertainty, volatility. I think that's where we get in trouble, in my mind. Anyway, keep going, Ann.
I guess maybe the question I would have as a follow-up from Harvey's comment is this a choice we're making, or is this practice among public pensions? You mentioned private pensions have a statutory obligation for a different rate.
Right, their rates are set by statute and by basically they're set by the IRS, what their rates have to be when they're discounting their liabilities. So this is a board decision on where they want to set their discount rate. It's also, the actuaries definitely have to sign off on that decision and be comfortable with it, but it is a board decision on where you think that discount rate should be relative to the assumed rate of return. So I think in your point too, Harvey, is that when you're looking at the assumed rate of asset return, and in this case, it's a little bit lower than your discount rate, and you want to set those two things to be close to being equal. So it's the board's preference to say whether or not they think that it's reasonable that you set this rate within a reasonable range around that expected asset return. And maybe when we get to the next few slides, it kind of go into more detail of what the expectations look like based on Makita and based on these other investment consultants. We can go into some more of that detail, unless you have another question to follow up with that.
No, I think I appreciate that there are two separate assumptions. I didn't until Harvey asked that question. So thank you. I do have one question on the slide, actually, which is unrelated, which is, do you have any data to suggest that the 24 pension funds in the 7% bucket are more, or what their funding ratios are? Is there some bias with funding ratio that you keep a sort of a higher percentage of expected return?
There definitely is bias with the different funded ratios there as well, because obviously the lower your expected rate of return or your discount rate is, then the higher liabilities are, which translates into lower funded ratios, right? So you know, if you revalued your plan at 7%, your funded ratio certainly would increase.
Sunita, let me just jump on this. Of course, and if I'm mistaken, correct me. Generally speaking, for the other systems in California, for the most part, their funding ratios are probably just about, but a bit higher than police and fire. So I know this because when I have my meetings with calibers and my peers, when we speak, I'm always have to speak for the fact that I work with a system that have lower funding ratios. Maybe not as much police and fire, but remember we also have federated, right? That's a different board. And so my peers across the state, and I think to Ann's point, most of them, not all of them here, but many of them are 37 counties. They're anywhere between the 70s to mid 90s%. In fact, the city of Fresno is over 100% funded. So I would say 1.5 of the other systems are higher than our funding ratio. But I think you should also think about the fact that just like your, whichever way you want to see it, your sister or sibling plan federated has a considerably lower funding ratio than police and fire on an actual basis in the low 50s, but it's also have the same assumed rate of return or discount rate. I thought Harvey's question, which he have asked in the past, was a very good one, on point. I think he has asked the same question every year for the last 2 or 3 years. Very helpful. The corporate plans have to use a risk-free return. I'm going to share with you a comment that I hear, and again, and correct me if I'm mistaken, that I hear often when I go to conferences and I hear debates between public plan actuaries and corporate plan actuaries, because believe me, they are different and they do argue. And it's because, corporate plans are here today. They could be gone tomorrow, whether it's because of bankruptcy proceedings or because they are bought out by another company. Less likely for cities or states to disappear. Not that they cannot go bankrupt, because as you probably know, I came from Puerto Rico, and they are as bankrupt as they can be, and the defined benefit plan is less than 1% funded. But that said, I think one of the thoughts on the actuarial public plans actuaries is that it is less likely for the liability of a public plan to disappear, thus their willingness to accept a higher discount rate to discount those unfunded liabilities than the corporate plans. So just a side note. Thank you.
Yeah, Roberto, you are right with that range of funded ratios. And you are seeing actually, there are some plans in California that are lower than this 60% that you talked about. There's some that are more in the 50s as well. And we're seeing a lot of plans this year, even on an actuarial value basis, at 100% funded. So there's that range there as well. So thank you. So here we're showing the impact of declining interest rates on how much risk needs to be taken in your portfolio in order to achieve the assumed rate of return. So even though over this 25-year period, the discount rate has come down, you're seeing increases in what we call the expected risk premium. So for example, back in 1995, you had an expected return or discount rate of 8%. However, the US Treasury yield at that time was close to 6.2%. So over 75% of your return was coming from these relatively risk-free assets. And then looking over into 2021, now your discount rate has come down, but the US Treasury yield has also come down. So what that has done is increase your risk premium, even though you've reduced the risk in your plan, according to your discount rate, you still have only about 20% of your assets where you're in risk-free assets. So you have to basically take on more investment risk to achieve that lower return in 2021. So moving on to future investment return expectations from Makita and from other investment consultants. We do have a model where we calculate the expected rate of return on your assets, and we calculate that distribution of what those expected returns are going to look like for your portfolio. And the inputs here are your asset allocation and the capital market assumptions for each asset class. On the very left, you can see Makita's 10-year capital market assumptions have been used in our model, and we calculated an expected return on your assets of 5.68%. And then over a 20-year period, it's a little bit higher at 6.5%. And this is really the expected average return for your portfolio. So 50% of the time, you're going to expect to be higher than that. 50% of the time, you're going to expect to be lower than that based on Makita's capital market assumptions. Then we also do a comparison with the Horizon survey, which includes about 40 different investment consultants across the country. And we do this for a comparison purpose so that you have more than just one data set to look at. And so they're about 20, we put their capital market assumptions into our model as well. And their outcome is that it's about 25 basis points higher than the Makita at 5.9% on the 10-year basis and about 6.8% on the 20-year time horizon. So this slide illustrates historically the range of Makita's 10-year and 20-year expected return on assets over a 6-year period. And it illustrates the fluctuations that occur with these capital market assumptions based on the market conditions at the time. So there is one outlier when you look at the 6-year period. You're seeing in 2019 how the capital market assumptions jumped up a bit there. And that was because in December of the year previous, of December 2018, there was a significant stock market crash and also interest rates began to rise. So investment consultants use the December previous to the year that they're making these capital market assumptions as their basis for their calculations. So you're seeing a big outlier in 2019. So to set the stage a little, history that's happened in the last 4 years for everyone is back in 2018, your plan, the discount rate here was 6.75%. And it was kind of at the top of that 10-year to 20-year range for expected returns. Then in 2019, when we reviewed the discount rate, we saw that the range of those expected asset returns was about 7.2% to 7.8%. However, knowing that this was an anomaly, the board decided just to stay the course and not to overreact to the current market conditions that year and stayed at 6.75%. The following year, the expected asset returns look very similar to 2018, and the board decided to reduce the discount rate, which put the discount rate within the middle range of those expected asset returns. And I think, just thinking back to Harvey's questions, this slide really shows what he was trying to get at there, where the expected asset returns are between 6.1% and 7.1% here, but we're setting how we value those liabilities based on the discount rate, which is based on the assumed rate of return. You want your discount rate to be in line with what that assumed rate of return is. And so the board decided to reduce the discount rate so that it was more in the middle of that range for 2020. And so here, now when we look at the range for 2021, that's come down just a bit It certainly is reasonable to stay at that 6.625% discount rate. But in the short term, you may see some actuarial investment losses because on average, based on these assumed rate of returns, your discount rate would be higher than those returns in the short term. So it's also worth considering maybe reducing the discount rate so that you're more within the middle or just down lower in that range of expected asset returns over a 10 or 20-year period. So here we have the board's decisions, or not. I think it's, I was talking with Roberto, it's fine to defer these decisions until the November meeting, but we are recommending no change to all of the assumptions, and we are suggesting that the board consider either retaining the same discount rate at 6.625 or reducing it up to 25 basis points, down to 6 3/8. But also 6.5 is reasonable as well. So there's, again, a range of where that discount rate is still reasonable within the concept of those expected asset returns.
Great, thanks, Ann. I don't think the floor is open. Anybody want to jump in? Go ahead and jump in.
Yeah, and on your previous slide, so if we sort of pretend we are in 2019, and we had chosen two different assumptions, one for the expected rate of return being, say, 7.5%, somewhere in the middle of that range, and kept the discount rate at, I guess it was, whatever it was, 6.75, is that what it was?
Yeah.
What would it have done to our unfunded liability? I know I'm putting you on the spot, but just
no, this is fine. No,
we had a first order calculus equation. What would it look like? Yeah.
So what it would have done to the actual liabilities is absolutely nothing, because the discount rate is what we use to discount the liabilities to the present value, to today's value of the dollars. So the liabilities would have not changed at all. So if we said, okay, but we're going to assume that the assets return 7.5%, that still wouldn't do anything for that valuation in 2019, because we look at the assets as at one snapshot, one point in time on the valuation date and make that calculation. Where that would differ is if we did our projections and then we assumed in our projections that we would that assets would grow with returns at 7.5%. So you would see the assets growing at a much faster rate than the liabilities. So as far as the actual valuation and how we do those calculations, they're always a snapshot, one point in time on that date.
That makes sense. But when you say projections, like one of your charts where you see the funded liability,
right,
unfunded liability going down. So that would have looked different if we had different assumptions.
Yes, I can go back to that slide specifically.
Yeah, there you go.
Okay, so if we had assumed, let's say this is 2019 in your example, and we have 6.75% as the discount rate, our liabilities would be projected to be the exact same as in this scenario. But however, if we said, okay, the asset return was much higher, we assume that's going to be much higher, you would assume that assets are going to grow each and every year in this projection at 7.5%. So technically your liabilities would only be growing at 6.75%, but assets growing at 7.5%. So you would see this unfunded accrued liability going down even quicker.
Makes sense. And obviously, if it's the other way around, it'll grow faster. Yeah.
Right. Yes, that's exactly the point Harvey was getting at there. And I misinterpreted that question, but those last couple slides definitely showed what those differences are in the assumed rate of return and the discount rate.
So would you be showing us some sensitivity before we make a decision on reducing the discount rate to 6.5% and what it does to that pink graph of yours?
Yes, we can come back in the November meeting and show some sensitivities or just show some projections of what those different discount rates would do to the contribution rates and funded ratios. In all scenarios, though, and just with the preliminary results that we have right now, is that the contribution rates or the contribution dollar amounts would not go up under any of these discount rate scenarios based on the 2020 projections. So it is, you would have one of those situations where your plan could take the opportunity to do that and see your contributions still decreasing or just staying level.
So would our incentive be to really go to 6.375 if that's the case?
Well, that's again where your board's risk preference will come into play. If you're looking at whether, let's go back to this chart here, if you're looking at wanting to hit your target earlier on in the first 10 years of this time horizon, then reducing the discount rate further you'll have a better likelihood of achieving those returns.
Without increasing the contribution, that's the key part.
Well, when you say without increasing it, it's increasing it relative to the 2020 projections. Yes, you're right. That you could decrease the discount rate to 6.375 this year, and your projected contribution streams going forward would still be less than your 2020 projections because of that investment return that you had.
Anne, can I jump into sort of piggyback on Sunita's question?
Sure.
So Sunita, your last question in regards to, how would that affect contributions? Anne is 100% correct that, it will affect the contributions for the city, but, it'll be offset by the market gains that we've had. So technically they'll probably have a drop, next year. Even if we go to 6.375, we'll have to see what the numbers look like. But the members' contributions will go up though. So in all the previous years, when we've lowered it, the contributions for the city and the membership have gone up the same time. But since this year we have so much, we have a larger gain, net gain, the payments towards the unfunded liability for the city is going to go down. And so overall their payments will go down, but the membership's payments will go up. And so that's something that I will be looking at. I'd like to see the numbers ran for, the three scenarios, 6.625, 6.5, and 6 3/8. And I want to see what that's going to look like for the membership, knowing that the city most likely will have a lower payment.
Right, and that's a really good point because the members, the tier 1 members contribute 3/11 of the normal cost. So when you reduce the discount rate, you're seeing increases in the normal cost, which is the cost of active members benefits accruing each year. So, and then in tier 2, they share half of the normal cost. So when you're seeing these increases in the normal cost due to changes in the discount rate, the members' rates will go up. And I do have some preliminary numbers on that as well. Like currently, the total aggregated police and fire plan member rates are about 12.7%. And then if you looked at reducing it to 6.5%, it would go up to about 13% on average. And then if you reduced it even further to that 6.375, it would go up to 13.5%. So you're looking at anywhere between 30 to 50 basis point increases over the course, over all of the members. And there will be differences between tier 1 and tier 2 and police and fire. So that kind of information we do bring back to you if you'd like to see that on that level, because it does impact each tier differently, each police and fire group differently, and the city differently.
Yeah, I would like to see it broken out, between tier 1 and tier 2. And you can do it the aggregate also, it's fine, but I definitely want to see the broken out. And that's something you guys have done in the past.
Yes.
Because then on top of that, you got to throw in, you might think, okay, going from 12.7% to 13% is not a big deal, but then we got to throw in the 8% that tier 1 pays for healthcare and 4% for tier 2's healthcare. So we're going from around mid 19%, to over 20% now, all payroll, for members. So, but yeah, that's something I'll be looking for next month.
Right. And I think that historically, this board has made decisions more incrementally because of the sensitivity of the member rates.
Correct. Yeah. And that's how we've always approached it. And
right.
This is just a unique year since we have such a large, net contributions that came from the market returns that, there's an opportunity to take advantage of this.
Right.
So.
But there's lots of stakeholders involved here. So it is important to also, to consider all of them.
Floor is still open. Anything else?
Mr. Chair, just probably a couple of comments. First one is that everything is equal, assuming obviously in the projections that we'll meet all the assumptions. I do remember Bill telling me some time back that a 25 basis point decrease on the discount rate would equate to about a little more than $150 million on an increase on unfunded liability, right? The second one is, I think all the questions that have been asked are very pertinent and important to address. I think having some sensitivity around it and more information on the next meeting will be helpful. I just want the board to remember also about the importance of addressing capital market assumptions. I leave that to our expert, Prabhu Palani, our distinguished CIO. But I think it will be helpful. I know Makita will not have the expected market assumptions for the coming year yet, but it will be also helpful in that discussion for the board to hear about what those market expectations are for the future, because I think that should also be part of the discussion. That's all.
Yeah, will we get that next month, Prabhu? Can you make that happen?
No, I'm assuming what Anne's showing is Makita's CMAs from January. And so Makita does.
That's correct.
Once a year.
Oh, that's right. You're right. We'll get them in January. Any other comments? If not, I'll jump in. Other comments?
So, Drew, if I can just add to what I just said.
Do.
The thing to keep in mind is the first 6 months of the year, we returned 10%. The market was up a little over that. And so if you divide this rule of thumb, if you divide that by 20, you would take away about 50 basis points of returns from your expected return, very roughly back of the envelope. But at the same time, you should also keep in mind that these are passive returns. And if you were to be generous to your investment staff, maybe you can add about 30 to 35 basis points of alpha. And so I would still think on average, if you look at the numbers that Anne showed, I think realistically, you would probably drop those expected returns by 10, 20 basis points. Then that's for the discount rate. So now going back to the assumed rate of return, so you could drop your discount rate by an 8. Going back to the assumed rate of return, it's also important to keep in mind that when we came up with our asset allocation, we had some cushion in terms of the risk. So that the risk that we came up with was about 11.7%, and our target is 12. So we could be 12, 12.2, 50 basis points higher. So we could keep the same capital market assumptions. We could slightly increase our exposure to growth assets. So there's a couple of different levers there. So all of those things should, probably come into play when we make the decision.
Right. So having driven a lot of this in the past, so we said we'd look at discount rate, at least the asset allocation return portion, through two lenses, right? The grading on a curve lens, what are other plans doing? Therefore, what should we be doing? And the absolute lens. And Anne has given us some direction on the relative to other plans. As Bill and Anne pointed out, starting when I first joined the board 10 years ago, you guys have a slightly different set of mixes and ratios. You have a slightly riskier plan, and therefore you should probably be on the low end of asset allocations, returns, discount rates on the risk. Take less risk, less return. And as Anne's pointed out in her charts, we're there, and Anne said, oh, and by the way, Drew, let me give you a little heads up. People are kind of drifting down. Other plans have had good years of taking less risk. But as Anne also pointed out, we were leaving that curve. So we are, relative to other plans, still have less risk than they do. And then on the absolute side, we said, well, how big a shock can the city take? And that led to that 12% volatility number that Peru was just saying. And as Peru's saying, you know, Drew, we got some motion in there. So as Anne is saying, you know, look, even if we could dial that knob, we never would, as Andrew says, because we really hurt people, turn down by 1%. That's where we were 8 or 9 years ago, trying to get to about 6.5%. And we're very close to that now. So to the extent that we might move the discount rate, I think 1/8 of a point, if we chose to move it. So why don't we go ahead and then, Anne, you've sort of got some homework assignments for next month. And we'll pick this discussion up then. Oh, Anne, when do we see the mortality stuff? When do you bring that?
So that'll be in November.
Okay, so we'll see that. We'll have all the assumptions and we can decide then.
Right. What we are seeing, just as and not specific to your plan, but public plans nationwide, we are seeing some mortality gains due to COVID, but they're not anywhere near as impactful as the investment returns that you have.
Wow, it's actually showing up in the numbers. Wow, that's something.
Yeah.
And just want to make sure that when you say mortality gains, that mean actual gains for the plan, correct?
Yes, it's not very politically correct. It's mortality gains are because we expect, you know, so many retirees to pass each year. If we have more retirees passing than we expected, we're paying out less benefits.
Yes.
So by paying out less benefits, that translates to a gain to the plan.
I get it. That's what you were saying, but I wanted to confirm it. So I just wanted to make sure that people were clear. Thank you.
I apologize if
no.
That's their actuaries speak.
That's not what I raised. That's what I raised.
Great. All right. Let's move on to it. Thanks, Anne.
Great. Thank you.
Thanks, Anne. 60 nominations for the position of board chair for the next calendar year. The floor is open for nominations for board
Mr. Chair, I would like to see you succeed for one more year, please.
Thank you, Trustee Santos. I would be willing to accept that nomination. Are there any other nominations for board chair? If not, then we will put that into the process. And we do the vote next month, Roberto? Is it next month we do the vote? Hang on, I'm looking.
On mute. I believe it's December.
Yes.
Yeah.
So,
all right, well, we'll follow the process. We, you know, sole nomination. Thank you very much. I'm very honored as always. All right, Maytac. Here we go. AB 361. Over to you, Maytac.
Hi, everyone. Thanks for having me, and thanks for your patience for a long calendar we have here. So I'm going to go over some of the factual findings that the board is required to make if it chooses to continue to meet virtually for the next 30 days. As some of you are aware, the governor's executive order expired on September 30th. That suspended certain Brown Act requirements during the COVID-19 pandemic to allow legislative bodies such as this board and its committees to meet virtually. However, the governor has signed into law Assembly Bill 361 as an urgency law effective October 1st with a sunset provision of January of 2024. AB 361 amends the Brown Act to allow local agencies and legislative bodies to continue to meet virtually during a proclaimed state of emergency under certain specified abbreviated teleconferencing procedures. Now, in order to use AB 361's abbreviated teleconferencing procedures, the legislative body needs to make certain factual findings to justify their need to meet virtually every 30 days. Now, this will require the board, if we want a continuity in the virtual meetings, to make certain factual findings here first for the next 30 days for this board alone, and then at the next meeting that we have within the next 30 days to make factual findings to cover the next 30-day period. This also applies to the committees, so the audit committee, investment committees, I guess I already said governance committees. You guys will all need to separately make your factual findings as well. And that's why part of the reason we asked you to stay after this meeting is to make those factual findings to provide you cover for the next 30 days. Now, here are the factual findings that are required that need to be made by the board if you choose to elect to use AB 361's virtual teleconferencing procedures for the next 30 days. The first is that there has to be a proclaimed state of emergency under the California Emergency State Services Act. Now, this is a threshold factual finding that is required. If there is no proclaimed state of emergency, you cannot avail yourself to the use of the AB 361 abbreviated teleconferencing procedures. And so that's requirement number one. And either A, the state or local officials have imposed or recommended social distancing measures, or the legislative body finds by majority vote that meeting in person would impose an imminent risk to health or safety of the attendees. Now, the last two I just mentioned, the social distancing and the risk to the health and safety of attendees, those are two alternative grounds for justification, but you can find both if you find that warranted. With the agenda, I've provided a memo with the current state of affairs for the COVID-19 pandemic applicable to the Santa Clara County and the city of San Jose to assist the board in its factual findings. But I would like to highlight and note for the board here today that the statewide proclaimed state of emergency is still into play. That's attached as Exhibit F to your memo. And also the city of San Jose passed a resolution on September 28th to continue the requirement of social distancing in city buildings. That's Exhibit G to the memo. These two items alone will allow the board to make the factual findings necessary to establish AB 361's requirement to elect the board's usage of the abbreviated teleconferencing procedures. Once the board has made those factual findings and elected to use AB 361's procedures, I would advise the board to consult item 1F to the agenda, which is a summary of changes that we've provided as communications to the board of what those procedures will be. Now, if the board chooses not to make the factual findings every 30 days, then the board would then revert back to the original Brown Act requirements of meeting in person within the jurisdictions, teleconferencing, posting of locations and whatnot under the traditional rules. And with that, I open the floor for questions and can provide further guidance.
So the image great text. So this great presentation is the factual findings, right?
Yes.
Any questions for Maytag?
Well, Mr. Chair, the way I understand it, we can make a motion to accept AB 361 and its findings.
Well, I would counsel the board to take a majority vote to make these factual findings and decide which of the grounds of the factual findings they choose to elect. So one, we have the proclaimed state of emergency is still in play, and two, the city council's resolution continues to impose social distancing in city buildings. those two grounds, if the board makes those factual findings as being current as of the date of this meeting, it will grant you 30 days from this meeting coverage to the next 30 days. And then at the next time we meet, we'll revisit those.
Because Maytag, the city's determination constitutes our interpretation of imminent risk.
No, it's just a factual finding that the state and local agency, that jurisdiction that you're sitting in, has recommended social distancing.
Okay, but you say here also we would need to determine that we believe that meeting poses imminent risk. Is that correct, or we don't have to determine that?
You don't have to determine that. That's an alternative route. So for example, if the city next month decides, I'm going to take out this resolution now that we've mandated all the city employees to get vaccinated before coming onto the premises, so we're no longer requiring social distancing, the board can alternatively decide we are going to do by majority vote based on the COVID rates in San Jose. That requirements, I'm sorry, I just saw it pop up that, you know, the risk is still there for the members.
Well, let me try floating motion. You can correct me when I do this, Maytag. So based on the governor's declaration of state of emergency, continuing state of emergency, and based on the city's recommendation that we meet virtually, I think we should, those factual findings should meet virtually. Is that a good motion?
Yes.
Oh, dang, got it right. Is there a second for my motion?
Second by Santos.
Thank you. Motion by Lanza, second by Santos. And then you say every meeting we're going to do pretty much the same thing, right, Maytag?
Correct. Yeah. So we will provide you a memo that will outline the current state of affairs to help you with your factual findings, and then the board can take a majority vote on whether or not the factual findings can be met to justify continued virtual meetings.
Great. Let's go around the room. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ashvar?
Aye.
Dick?
Yes.
Franco?
Aye.
Dave?
Aye.
Chair Lanza, I vote aye as well. Hey, Maytag, sort of procedural. We're going to go through the committee reports one by one. Can we do the vote there, or do we actually need to sort of convene the committee after this meeting?
You have to convene the committee after the meeting.
All right, so everybody
have...
after the end, we'll actually do that. And do we have to do that every board meeting going forward?
Correct, because each of the legislative bodies individually have to make their legislative finding. And in addition, for certain committees that do not meet every month on the regular schedule, we will have a special meeting for them to cover them to go to the next month. So it's an imperfect bill. 30 days is not realistic, but that's how the governor and the legislature made it.
All right. Great. Let's go through the service retirements. Johnny Dellinger, Battalion Chief, Fire Department, effective October 17, 2021, 27.82 years of service. Barry Allen Ehlers, Fire Captain, Fire Department, effective September 19, 2021, 25.64 years of service. Sorry, hang on, guys. Jill Ferrante, Police Officer, Police Department, effective October 30th, 2021, with 26 years of service. I read at the beginning of the meeting change to October. No, that is the correct. The change is there, so that's the correct change. James Lee, Police Officer, Police Department, effective October 30th, 2021, with 26.07 years of service. Do I have a motion to accept those?
Motion to accept, Santos.
Second by somebody.
Second by Wilson.
Second by Wilson, thank you. Motion by Santos, second by Wilson. Andrew?
Aye.
She must have stepped away. Howard?
Yes.
Far?
Aye.
Franco?
Aye.
Dave?
Aye.
Chair Lanza, that's more than 5. Vested. Nunni Dong, I apologize if I've got that wrong. Police Officer, Police Department, effective October 11, 2021, 25.3 years service. Hector R. Estrada, Deputy Fire Chief, Fire Department, effective September 28, 2021, 23.42 years service. Michelle Lilly, Fire Engineer, Fire Department, effective October 30th, 2021, 29.64 years of service with reciprocity. I'm not going to go through the whole thing. Michael D. Wharton, Police Sergeant, Police Department, effective October 16, 2021, 25.71 years service with reciprocity. We have a motion to approve those.
Motion by Santos, yes.
Yes. Is there a second?
Second by Wilson.
Second by Wilson. Andrew.
Aye.
Anita. Howard.
Yes.
Schwab.
Aye.
Dick.
Yes.
Franco.
Aye.
Dave.
Aye.
Chair Lanza, I vote aye as well. You guys want to make any comments about any of those folks?
From Santos, we just wish him the best and good health.
Anybody else? All right. We will go through the members of ours that have departed, and we'll have a moment of silence. Notification of the death of William H. Adams, firefighter, retired December 26, 1998, died August 4th, 2021. Survivorship benefits to Lorene Adams, spouse. Notification of the death of Mario Busalaki, fire captain, retired June 26, 2010, died August 22nd, 2021. Survivorship benefits to Linda Busalaki, spouse. Notification of the death of Stephen G. Heck, police sergeant, retired July 31st, 1994, died August 6, 2021. Survivorship benefits to Patricia Heck, spouse. A notification of the death of Gary Schneikert, firefighter, retired July 3rd, 1993, died August 6, 2021. No survivorship benefits. And notification of the death of Jack O. Woodall, police lieutenant, retired March 12, 1995, died July 11, 2021. Survivorship benefits to Judy Woodall, spouse. We'll have a moment's silence. Thank you. I don't know if any of you want to make any comments about any of these folks.
I sure do, Drew. I work with all of them, and it's a very sad time, but we sure appreciate their service to all the residents in San Jose.
That's great. Anybody else? Thank you. If not, we'll move on to committee reports. Investment committee, any updates thus far?
Nothing. Last meeting was in August. We have a meeting coming up end of this month.
Audit risk committee. I think Suni just said she had to duck out to a meeting. Roberto, they haven't met, right? Nothing to report?
Yes. Nothing to report.
Great. Governance committee. Franco, anything to report?
I don't believe we have anything.
Okay.
Governance, nothing to report, but we do have Tommy Anucci. He should be available to discuss some of these items C and D.
Is he on?
Yes, he's on.
Yes, I am.
Okay, good. Over to you, Tom.
Thank you, everybody. Thank you, Mr. Chair. Let me just share my screen. If I could get permission, please. Oops. It's still disabled.
You should be good now, Tom.
Okay, thank you. Let me try that again. It doesn't seem to be. Okay, can everybody see that?
Yes.
Okay, this is the board education policy. It was reviewed by the Joint Governance Committee. That review was prompted by the Federated Board's 2020 board self-evaluation, where there were some recommendations and suggestions to review and try to enhance this policy. So both governance committees jointly reviewed the policy. They had several meetings to discuss it. covered a lot of ground, made a number of proposed revisions for board consideration. These are identical revisions going to both boards separately. Most of the revisions are fairly minor and clarifications, but some of the suggested changes represent changes in practice. So I'm going to just draw your attention to the proposed changes in practice. The first one being in regard to paragraph 4, which outlines the components of the board's education program. The committee is recommending that we add another element to this, which we call mentorship. Mentorship from experienced board members to new trustees. And we will elaborate on that in a later paragraph. The next change in practice is paragraph 5A. And again, it relates to the trustee orientation program. It was suggested that getting the orientation once at the beginning of the tenure is great, but it would be valuable to get sort of a refresher 1 year later. So we've added a provision that each new board member would attend orientation within 3 months of joining, and again, upon completion of 1 year of service on the board. So this would be sort of a reinforcement of the original orientation 1 year later. And again, this is only going to affect new trustees. The next change in practice is paragraph 5F, which simply describes what we mean by the new mentorship component. And all that says is that each new board member will be offered the services of a mentor for at least the first year of their term on the board. It's going to be optional, but they will be offered that, and they can choose whether or not to take advantage of that. And the purpose would simply be for the more experienced board member to provide additional support and orientation and guidance to the new trustee. And the other change would be in item or paragraph 4, which simply requires that management is going to consult with each board member, new and experienced, on a regular basis to gain feedback on their progress and their needs in respective education, so that staff can try to provide them more personalized guidance and support to further enhance their education efforts. And it's expected that these consultations would happen at least annually for the experienced board members and possibly more frequently for new board members. So not controversial changes, but they do represent changes in practice, and I wanted to bring that to the board's attention before you consider approving the policy. Happy to take any questions.
Floor is open. Any questions? So this is set to be adopted, right, Tom?
That's correct.
All right. Well, I move that we adopt this education policy. Is there a second?
Second by Howard.
Great. We get the list out here. Andrew. Andrew, you there, buddy? Let's see. Sunita is gone. Howard?
Yes.
Ishvar.
Aye.
Dick.
Yes.
Franco.
Aye.
Dave.
Aye.
And Lanza, aye. That's, I think, 7 ayes. That's great. Now, next, go ahead. Keep going, Tom.
Thank you. Moving to the next item, I'm going to share my screen again. And I hope you can all see that. It's the 2021 Board Performance Assessment Report of Findings. You can all see that? Thank you. Just as a reminder, this is a process that the board by policy undertakes every second year. So 2021 was the schedule for P&F, and Federated goes through the same process in alternating years. The evaluation consists of every board member being invited to complete a board self-assessment survey, and then given the option or the invitation to participate in follow-up telephone calls to elaborate on any of their survey responses. And then those results and the interviews and the themes are summarized in this report, presented to the governance committee, outside of a joint meeting. So the governance committee for police and fire met separately to review this. And the committee then recommends the report to the board. So for 2021, 7 of 9 board members completed the survey, and 5 board members participated in follow-up telephone calls with me to provide a little more detail on their responses. And similar to past years, the results have been incredibly strong, slightly stronger even than last year, despite the pandemic and all the challenges that presents for board meetings. A lot of areas of strength. Again, this has just been improving year over year since I've been working with this board. Very collegial, very professional. Things are really getting very efficient. And the board members commented, particularly in these surveys, on just how effective and successful the board has been in maintaining operations, particularly over the difficult past year and a half. And it was also pointed out that member communications has been improving, which was an issue that was raised in the past. Similar to past years, board members identified some potential improvement opportunities. And it looks like a long list, but I want to stress that these were all isolated comments. There were no themes. These were all identified by single board members. So I didn't see any real consensus here by any stretch. It was always one person suggesting this, and everybody qualified their comments that things are going really well. These are just, we can always improve, and here are some ideas. So these 9 suggestions were included in the report. They were presented to the governance committee, and the governance committee accepted them as is for recommendation to the board. They did not add any additional improvement opportunities. They didn't delete any opportunities, and they didn't endorse or emphasize any of these opportunities. They wanted them to be simply presented to the board for discussion so that the board could decide if they wanted to pursue any of these in particular, or send them to staff for further consideration, send it back to the governance committee for further consideration. I'll quickly just run through them. One, and again, always isolated one-off suggestions. Find ways to delegate more to board committees to enhance board effectiveness. Continue finding ways to reduce the number and length of board meetings. That's been issued, or sorry, that issue has been raised in prior evaluations. Undertake a project to determine how past governance decisions led to the current funding position. So what they called governance attribution, figuring out which decisions had an impact, positive or negative, on today's funding position of the plan. Again, this is a suggestion that was identified in past years. A new item, item 4, prepare for the possibility that both the CEO and CIO could retire at the same time, which would be particularly challenging if multiple board members also retired at the same time. So this was just maybe put some thought into that scenario from a succession planning point of view. Continue to improve, work to improve telephone response time and consider providing a live attendant. This is more of an administrative matter, but something that the board could potentially provide some direction on. Continue to be vigilant about accepting the outputs of the asset allocation modeling exercises and not attempting to make minor adjustments to the outputs based on intuition. This was an issue that was identified and addressed in the investment governance project from a few years ago. And the individual raised it, didn't suggest there was a problem, but just suggested that we just need to be aware of this and continue to be vigilant about it. Suggestion 7, consider whether committee reports to the board should contain greater detail regarding the activities and discussion that occur at committee meetings and some indication of what the committee is going to be doing at subsequent meetings. The board member said the reporting has been improving, but still felt that the current report doesn't necessarily provide a deep enough picture of what's going on at the committee level and thought they could be improved. Consider providing more in-house education to the board, continue to enhance the board education policy, including mentor support to new trustees. And we've tried to address that in this current version of the education policy, which you just approved. And then consider the value of having, last suggestion, consider the value of having the investment committee meet periodically with the investment consultants to discuss potential improvements to the fund. And the idea there was that the committee, of course, does meet with the investment consultant, but given that staff is very busy, perhaps there might be some room for additional meetings when staff are not present, and the IC could meet with the investment consultant in those sorts of situations. So those were the 9 recommendations, each of them isolated, coming from one board member, not the same board member, but different board members, but always one at a time. And the proposal is for the board as to what they'd like to do with any of these. Would they like to pursue any of them, or send them to staff to come back with recommendations, or perhaps send them back to the governance committee? So with that, I'll leave it open for discussion.
Right. So, give me a second here, Tom. So I would suggest to the board, unless somebody's got a better idea, that we accept this report, and I'll go offline with Roberto. We meet every month, and I'll go offline with Roberto, and we can put our heads together about how we might want to go forward in talking to the board about individually which of these they would want to take up and which they'd say, nah, not really. Does that sound okay, Tom?
Well, that's a reasonable approach. I know it's tough to deal with all of these issues in a board meeting. I think that's an effective way to handle it.
Yeah, so we wouldn't have to vote on this then. I just said note that we accept the report.
Correct.
And board, just, if you go to the board, I'll go offline with Roberto on this. So I'm looking for nodding heads. That sound good, board? We'll do it that way. I see nodding of heads, great. And then let me note for the record that we accept, hang on. We accept the minutes of June 17, 2021 joint governance committee. Let's see, disability committee, Dick, anything to report?
Well, we have our meeting at 8:30 in the morning on Tuesday, October 12th.
Great to see you there, Dick. And let me note for the record, we accept the minutes of June 7, 2021 Police and Fire Disability Committee meeting. I think I'm the chair of the JPC, and we haven't met. We're going to meet. I just been on emails floating around.
Drew, I just want to. I just want to mention, yeah, we're going to be sending a survey out to see when we can meet. You may recall that this is the only joint meeting of the boards. There's no chair. The committee actually have to select a chair at the next meeting.
That's right. Yeah, thanks, Roberto.
Yes, and I think Spencer reminded me on an email earlier today. Spencer is the chair for Federated. That because right now they only have 5 board members, they're not able to have the 3 of them attend the meeting because that will constitute a meeting of their board at this time, which means that next time this committee meets is only going to be, which is okay for quorum, will be 3 from Police and Fire, but only 2 members from Federated.
Yeah, oh, that's right. I saw that email from Spencer. Great. Any comments from the public? Anything at the end here from any of our trustees or staff or consultants?
Drew, I do want to remind everyone that we're going to have these special meetings right after the meeting is adjourned. We have to wait about 20-30 seconds. So unlike other times when the meeting is over and you all leave, if you could be kind enough to stay for a few more minutes until your committee meeting comes up so that they can actually do the motion that the board did earlier on AB 361 so that you are allowed to continue having virtual meetings. Thank you, Drew. Thank you.
Great. So everybody stay on the Zoom call for 30 seconds. That's a note to our video crew. Go ahead and switch gears.